Hi everybody, this is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. Today we're going to talk about a tax-exempt trust and when that can make sense for you. Take a look at this scenario. Imagine you having a property that you bought maybe in the 70s or 80s for $300,000 that's now worth $3 million. That's a gain of over $2.7 million. You're going to have to pay taxes on that. That could be almost $1 million in taxes depending on the state that you live in. And that's not even including if you depreciated that property down where the cost basis is now, frankly, about $100,000. So that could be over $1 million in taxes. So what strategies could make sense for you? Well, a tax-exempt trust is great for when you have appreciated assets. Here's how it works. You can retitle that property into a tax-exempt trust and take that property or asset and donate it to this tax-exempt trust. Make sense? Let me explain a little more. When that happens, you no longer own the property. So this could be a great estate tax planning to remove something from your name. That's number one. Number two is this property, you're allowed to sell it inside of this tax-exempt trust and pay little to no taxes at all. Sounds pretty great. And then the way it works is you live off the income for life based on your life expectancy. So if you're 65 years old, for example, and you put $3 million in here, you may be able to get $150,000 to $180,000 a year, depending if you're married and your spouse has the same age of you, roughly. So why is that important? Because then you get to live off this income stream for life. And if you outlive this so much and it starts eating away at the principal, that's fine. There's two catches in this. Catch number one is you have to leave 10% of this. You get to liquidate 90% of this over time, but leave 10% to a charity of your choice. Now, your money goes three places, even today. Number one, it either goes to you, goes into your pocket. Number two, goes to the government. Number three, it goes to a charity of your choice. If you're complaining about high taxes, give all your money to a charity and show you have no income. You get what I'm saying? But the reality is that your money goes to three places. You or your heirs, if you're no longer living, the IRS, or charity. You're just choosing charity here, especially if you only have to leave 10% to them, you still collect the 90% throughout your lifetime. It's sure better than paying 1/3 in taxes to sell the property. And here is another thing on a catch that you have to be aware of. If, God forbid, you died the very next day from 65, let's say you die at 66, then whatever's remaining in here goes to the charity. So you do have to be charitably inclined for this work. Now, another benefit of doing something like this is if you put $3 million, because you said on day one, your intention is to leave 10% of it to charity, well, that means 10% of the $3 million that you put in, which is $300,000, is a tax write-off this year. That's a tax write-off you could take advantage of. Guess what you could do with that? You could do a Roth conversion the very next day to make it a net tax neutral of a situation. So folks, there are multiple ways you could take legal advantage of the tax code to help legally reduce your taxes just by being tax strategic. Whether number one, you want to live off the income, number two, you want to give to charity, and number three, to do tax strategies while you're alive. You don't want to give to charity when you're dead. You don't get any tax benefits for doing that. Do it while you're alive. And something like this, you can enjoy the income from it and still give the benefit to the charity. Hope this was helpful. If you have any questions, please reach out below.